Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Monday, December 30th, 5:23 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. Before we get started, got an announcement to make. So if you've been following us for a while, we've spoken several times. When I say we, I mean me and Dan. Back in around mid 2023, Dan and I took some of our personal money and started seeded portfolios for Ted and Connor to trade using GROTECTION rules, but we allowed them to be a little bit more aggressive than we are. They could buy larger position sizes. They could buy some things that weren't as liquid as we would normally have for GROTECTION. And basically, this was to establish their track record. Like I said, they had to follow grow rules, but it's a basically a more aggressive version of GROTECTION, and we're going to call it Turbotection, and we're going to roll it out on at the beginning of the year. It's the results have been really good. These guys know what they're doing. Anybody that follows them, listens to the videos, they're studs on Twitter. I'll put them up against any technician in the market. They are dedicated to their craft. They put in the work and can be happier to have them on board and to give them this opportunity to grow aggressively for people it has to be a suitability match. So we'll be talking to anybody that's interested in this, but happy to announce that this will be started, as I said, at the beginning of the year. It's probably about a third to a half more aggressive than GROTECTION. So not suitable for somebody going into retirement, but for somebody younger or somebody that wants to have just a small piece of their uh, assets in a more aggressive strategy. Talk to Danny and we'll go from there. So rolling that out next week, later this week, early next week. So state of the market, we're in a weakened uptrend, and that might be being generous again. We've the market has around Christmas time and New Year's, liquidity is low, and the market makers can and the algos can play around and move things around. We started off, we've talked for a while about the 7 day Santa Claus rally. It's the final five sessions of 2024 and the first two sessions in 2025. And this historically is the best 7 days of the year. It presents a 1.3% average return. And we kicked it off nice on Christmas Eve when the market was up over 1%, followed that up on the 26th with a tiny gain, but then hard selling on Friday, and that followed through today to the downside. So, uh, what happened today? We'll describe it as gap down. There was a morning rally, making you think that maybe this was just a big shakeout, but then we faded again into the close. So, check the trend gauge over here. Market leaders, we downgraded those on Friday, added the red sub arrow over there. For the most part, really, there are a lot of still nice looking charts, easily 40 or 50 growth leaders, still holding up okay. So no worse than neutral there. Short term, however, uh, S&P 500 broke the 21 last Friday, broke the 50 today. The NASDAQ 100, the QQQ, broke the 21 day today. So we've got the yellow arrow with the red sub arrow on our short term 21-day moving average, and also the yellow arrow with the red sub arrow on the 50-day moving average as well. The NASDAQ 100 is the only of the six indexes that we track that's still above its 50-day moving average. Long term, though, we're still comfortably, well, not as comfortably for all of the indexes, but we're still above the 200-day moving average. The market never gets into serious trouble unless we break below the 200-day moving average. That's where we studied a lot of bear markets. They all occur under this level. And really, for some perspective, the S&P 500 is only 3.2% off of its recent high. So while there is a lot of ugliness out there in various sectors, small and mid caps do not look good in any way, shape, or form. Leaders still holding up. It's an anomaly, but it's what's happening. They're being supported on pullbacks. They're being bought on pullbacks. Um, they had some rough days last week. That happens. That's really the main reason why we have 30 to 50% of our portfolio in the S&P 500 to cushion against those big down days in growth names. Does no good to have a 4 or 5% up day and then follow it with a 3% down day. We always have sought to have a smooth equity curve in the GROTECTION. So gap down, morning rally fades into the close. Here are the final numbers. The 21 over 21 down about 1% on average, 4 up, 2 neutral, 15 down. Now, leading stocks, I mean, this is more proof that growth leaders are holding up okay. They normally are 2 to 3%, 2 to 3 times what the market average does. But here that today they were just in line and really not a lot of damage done to anything. And we'll go through our 21 over 21 list for this week at the end of the video, and it looks fine. Big 8 down 9/10, 7 out of 8 of them down. The RG8, however, and again, this is an anomaly. Broadly speaking, the RG8, this is our 8 growth ETF composite. All 8 of them were down today, including the one we tracked the most, which is FFTY, down 1.9%. That's the IBD 50, down an average of 1.4%, but leaders hanging in there. S&P 500 gap down 1.2% at the open, rallied to within 0.5% of green and then faded. Last 30 minutes were ugly, closed down 1.1%, equal weighted down 1% as well. So this was broad selling early. All 11 sectors were down, 10 of the 11 except for oil. Oil was green today. So when we see that, we try to determine is it just the big caps that are dragging down the S&P? But no, RSP was down as well, and the NASDAQ 100 was down. And you can see what the rest of the indexes did. 60/40 down a little less than 0.5%. Our flagship GROTECTION down a little less than 1%. So let's get into the charts now. We'll start off with the S&P 500 on a daily chart, and you can see undercut the 50-day moving average week and a half ago, got back above it last week, 2 closes above it, part of the Santa rally, but then a decent close on Friday as we bounced at the 50-day moving average. That's the red line, but closed below the 21. Now the 21-day is rolling over. That's the green line. And on the rally today, we ran into what? The 50-day moving average. So what we really don't want to see is that 50-day starting to act as resistance. The S&P, we want to see that get right back above today's high and that 50-day moving average to keep this, we're calling it, as I said, a week uptrend to keep that alive. NASDAQ 100, the QQQ, back above the 21 last week after never broke the 50 and is still above the 50 today. Back above the 21 last week, undercut and reclaimed the 21 on Friday, gapped below the 21. The entire range today was contained with the 21-day moving average on the upside, the 50-day on the downside. So that'll be one of the keys to monitor what that does tomorrow. Dow Jones Industrial Average up next. Below the 21, below the 50, hanging around this 42,000 level. Let's look very quickly at equal weight S&P 500. And this undercut the low from a week and a half ago and got back above it, but still near the bottom of the range. And versus the 200-day moving average, only 1.8% above that. Compare that to the S&P 500, which is 6.5% above the 200-day moving average. Let's go to mid caps now. Down 0.7 on the day, another undercut of that that Friday, 2 Fridays ago. That was on the 20th. So shakeout below there makes the lows of today pretty crucial. If you draw a line sideways, you can see this is a big support area above the 200-day moving average for mid caps. And the Russell 2000 small cap didn't undercut that Friday, but bounced at the 2200 level. So minor relative strength for small and mid caps today. A little bit of relative strength to close the week last week on them. In fact, one of the videos that I did on Thursday was taking a look at whether or not that relative strength was going to continue We really need to see interest rates, the 10 and the 30, start coming down to give small and mid cap stocks any hope, and maybe some easing in the dollar as well. But for now, bouncing at that 2200 level, but below the 21 and below the 50-day moving average. So those are the six major indexes. Let's go to interasset correlation. We'll start with the VIX. The VIX was today by 9.1% at 1740. Back above the 200-day and the 21-day moving average. We really, again, want it to be in that 14 to 16 level. 16 implies a 1% average true range looking forward the next 30 days in the VIX, but back above that with a 17 handle today. How about the dollar? Dollar is flagging here. Ted drew this very nicely on Friday, and closed mid-range today, undercut and reclaimed the 8. It was stronger early, faded a bit, and then bounced, just moving the opposite of what the indexes were doing. So is this controlling the dollar, or is the indexes, or are the indexes controlling the dollar? Currencies do have inverse and positive correlations. It's important to determine what's going on, but you can see by this um, sideways to up move in currency, this has coincided with a little bit of weakness on the indexes. How did that translate to precious metals? Normally, an inverse correlation between precious metals and the dollar. That faded a bit while the precious metals were strong back in the July through November timeframe, but we're basing now under the 50 and 21-day moving average, near the bottom of the range. We want the bottom of the range to hold if you're a gold bug. GDX gold stocks look much worse than the precious metal does. You can see making new lows below all of the key moving averages. Silver SLV also below all the moving averages, trading tighter than GDX. And how about Bitcoin? Bitcoin started out ugly today, but put in a hammer, undercut the low from last week. Still below the 21-day moving average, but good to see a little bit of a few buyers coming in as the day progressed. Over to bonds now. Broad bond index BND bouncing into the declining 8-day moving average. TLT, if price is up, this means yields were down. This seemed like more of a fear trade today into bonds than it did, as opposed to last week where rates were going higher, due to economic outlook and reaction to the Fed. But there's TLT. Let's take a look at the 30-year yield. The TYX down a bit, and TNX, the 10-year, down a bit as well. So that's our interasset correlation charts. Let's go to the tail of the tape. Week uptrend, as we mentioned, stochastics on the indexes and the RG8 fading. The NASI is going sideways, but it is oversold. RG8 oversold as well. So again, like I said last Thursday, the setup was there going into Friday, but it certainly didn't come to fruition. We had two back-to-back bad days now during what is supposed to be the seasonally most important. We don't explain it. We don't try to explain it. We just agree that price and volume are what we need to obey. Percent of stocks against the 5-day got way extended last Thursday, pulled back hard now. It's below that 20 level. That's a green light. That's a look for a bounce to the upside. And this percent of stocks against the 5-day has been a pretty good short-term indicator. Talked about the VIX, fear and greed in fear at 28. Nothing to really be concerned about either way from a bull and bear sentiment perspective from AAII or NAAIM. Bull and bear case bouncing back and forth between these levels. The news, as I said, the Santa Claus rally, we're now down 1.12%. Supposed to be up 1.3 by the time this is over. We're going to need a strong rally over the next 3 sessions to hit that. I remember last year, most of the gain was in the 45 minutes on the 7th day. It was kind of a crazy close on that second trading day of 2024. We'll see what 2025 brings, but as always, we're obeying price and volume. Keys today: S&P against the 21 and the 50-day, broke below both of them, or stayed below the 21, broke below the 50. NASDAQ 100 broke below the 21, still above the 50-day moving average. Second day down, second day below the 8 and 21 day moving average on the S&P, and our expectations now neutral or negative, with both of those being below the 21-day moving average. As far as sectors go, only thing to the upside besides bond prices and the dollar, dollar not up that much, but oils stand out today, especially nat gas related. XLE was basically flat. To the downside, 10 out of 11 of the spider sectors, XLE actually ended up closing down 0.01%. So really call it 11 of 11. And to the downside, semiconductors, retail, and biotech. All right, so the portfolio with that move below the 50-day moving average, that was our signal intraday with no rally back above the 50 to close that SSO, the last half of that SSO position that we started last week. We did, during the recovery, add to a standout RBRK. We started this last week, position last week. It was the standout strength, most strong growth leader today. We added a little bit to that. That faded into the close. And two oils we bought. There are about four or five really strong ones. We bought small starter positions in EQT and AR. They have a nat gas bent, and that was what was keying the rally in oils today. So adjusted beta 1.08, basically 0.08 above a portfolio that's 100% the S&P 500. Our rebar, that's Revere estimated balance at risk, down 3.31% to the downside. This is an estimate, of course. That's what the E in rebar is. There are always going to be gaps through our stops, but we don't do cowboy position sizes here in the GROTECTION portfolio. They're reasonable so that we never get hurt with big gap downs and having a huge position in something. Our goal is to keep the equity curve smooth. So with those changes, as I said, adjusted beta 1.08. Bottom line on the day, second straight gap down open, late morning rally, faded into the close. The key for tomorrow. We did bounce at this level down here. Always pay attention to what we have on these key levels because they are very important resistance and support levels. We had this 58.50 to 58.78 October resistance and November support noted. We touched that and bounced on 12.19. We touched that range and bounced again today into the close, closing at 59.07. So that's a key level. And three levels to watch on the S&P 500: the 20-day, the 21-day, of course, 50-day, and that 58.50 bottom of that range. We need to stay above 58.50 at the worst. NASDAQ 100 tomorrow will be keying on the action versus the 21E and 50-day moving average. So let's get to the 21 over 21 list, and we will sort them by positive gains for today. And you can see what we bought. Antero AR, great growth numbers for 2025. Here's the weekly chart of it. Nicely formed cup and handle, above average volume on the breakout, 87% above average. If this was a traditional growth stock, it would be extremely exciting. It's an oil. We'll settle for it. The relative strength is supporting. Not going all the way back to May because oils have had a bad stretch here since the summertime, but this is a clean breakout from a cup and handle in an oil with a nat gas related bent and good estimates for 2025. So AR, we bought that. Next up is the second oil that we bought a starter in. Don't know which one of these or if the true leader is yet to emerge, but EQT, this one's in oil gas integrated exploration, production, and distribution of nat gas and oil. Nice setup here. It actually moved out 4 weeks ago, pulled back along with the rest of the oil patch, busting above this 45 level today on above average volume. So those are the two that we bought, and those were the two standouts in the 21 over 21 list today. Moving on, CRDO, nice tight action over the last 4 weeks. This is kind of typical of what you're seeing in the growth leaders that are holding up. Some undercutting and reclaiming the 21, some undercutting and reclaiming the 8, some pulling back to the 50-day moving average. Those are the weaker ones, and you won't see any of those on this list because they get cut if they break the 21. But a familiar pattern is what you'll be seeing as we scroll through these. EXPE, a little bit longer of a base, but strong since its earnings gap higher. APP, tight action after a very strong move up after its earnings reaction, and now trading straight tight sideways for 3 weeks, holding the 21-day moving average. Rubric, this is the one that we added to today after buying last week when it showed relative strength on Friday, broke above the 70 level, and we added to it today, but faded into the close. But pretty good demand on that over the last couple of days. But as always, that can change, and we've got our stops in place if it does. Twilio bouncing at the 21, Deckers bouncing at the 21, Google going sideways and holding up very well since it announced that Willow quantum computing chip, and that's what made it gap out of this base on 1210. Celestica just keeps bouncing at the 21. This is a AI data center play. Oh, that went too fast here. Bros, don't want to skip Bros because it's got a green flag next to it, which means we own it in-house. That undercut and reclaimed the 21-day today. Next up, Marvell holding the 21, a little bit more volatile than I would like it to be since its earnings gap higher. Teva Pharmaceutical. This is a generic drug maker, but they're getting into making some unique drugs and got a good phase. Not sure if it was phase two or phase three through trial result, but anyway, it's been being bought since that gap up on that news, as you can clearly see, trending above the 8-day moving average. SoFi, a little bit more volatile again than I would like it. See this big down candle, 8.5% on above average volume on 1218, but for the most part going sideways over the last 5 weeks after a nice run up. Palantir pulling back for 3 days after making a higher high last week. AVGO holding the 8-day moving average. That's what you want to see after two extremely strong days up on volume. IonQ, quantum and liquid. So a little late to the list. We probably should have had this on a little while back. You know that there's a bunch of penny stock type action going on in some of these quantum names, which we don't play. We stick to institutional names, and IonQ is a leader in hardware. They even have some sales, but um, right now riding for the most part the 8 EMA higher with a test of the 21 a couple of weeks ago. Tesla, 3 days of a pullback, still holding above the 21. Rocket Lab, 2-day pullback after attempting higher highs. A Lab, uh, undercutting and closing right on the 8-day moving average, one of the strongest stocks in the market. And finally, Reddit holding the 21-day moving average, 3 days pullback now. That's it for the 21 over 21. As always, we'd like to hear from you. My email is don@revereasset.com. The phone's 855 Real Wealth. That's 855-732-5932. We've just been getting a flood of new clients coming in, keeping Dan and Muriel, our onboarding director, very busy, and we love it. The time to bring your assets to Revere is not after the gains that you made over the past year evaporate. The time to bring your assets to Revere is when you're at the top, so we can institute our sell discipline to keep those gains that you got. No reason to give them back when you have the proper market technicians looking after your portfolio. And that's what we pride ourselves on here at Revere. And that's why we've grown to almost $220 million in assets under management. Huge 2024 for Revere and our clients. And that's going to wrap it for Monday, December 30th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.